means for buyers, or what it means for buyers is danger.
Danger.
Because if rates go down, then this opportunity that is in front of us is not going to last.
That is true, because I tell people not to time the market, but if I were to time the market, I'd be a buy right now because
pricing is like you have the most opportunity to negotiate, tens of thousands, and it's right before rates get down, so you're going to be able to refi relatively quick, most likely.
Yeah.
I mean, rates are already starting to tip down, but
the stat that we've heard is for every 1% the rates come down in the state of Utah, nationwide it's 5 million. 5 million more people that are now eligible to buy that previously weren't. And
we assume there's 1% of the
national
population here in Utah. So
there's 50K.
50,000 home buyers per 1% drop in rates. I mean, just in the past month, we probably dropped 0.75 of a point.
Yeah. Yep.
So 35,000 home buyers.
Since January, we've dropped over over 1 point.
Oh, really?
Yeah.
This year.
Yep.
And I mean, we're seeing it.
Oh, for sure. Yeah, we're seeing it in applications. For a minute, it was we're like, okay, where are all the buyers at? It turned into a ghost town, which is why we started to see so much more in concessions. Now you're getting the best of both worlds.
And we're noticing it on accident. It's not like we constantly drive, from a sales standpoint for production,
busy.
But our database has been virtually absent from our business for several years now. And now we're just getting, you and I, refis and purchases, honestly, multiple a week that are unprovoked.
Multiple texts per day. Just wanting to review the situation, which is something we're totally stoked to do. We're going to review your situation and give you the real advice. Because I don't want you to refinance if it doesn't make sense. I'm not going to
dude, I've told more people to not refi than I have told to refi.
Yeah.
In the past, even in the past several years, I've told them that.
Yep.
We have refied other people that make sense, but
yeah. So we'll run through your goals and your scenarios, and if it's if your break even is going to be months, if not years out, we're going to tell you no.
Right. And the way we structure it is, in our opinion, the most creative, the best way to do it, which is 99 times out of 100, these refinances are structured in a way that you make your money back before you make your first payment on the refi.
Yeah,
so there's zero break even. So if rates go down again next month, you can refi again. You probably wouldn't.
Yeah, let's analyze why that is. Because when you do a new loan, your first payment isn't until the first of the second month after closing.
Right.
So if you were to close in October, you're not making your first payment until December.
Yep.
That's 2 months of mortgage payments that you can keep in your pocket, which people don't realize.
Yep, which is huge. And that helps you break even, but nonetheless, the monthly payments, we're people are legit. There's no break even period. I got a client.
Let's analyze this. So at going from a 7% to a 6% rate on a $500,000 house, that takes your principal and interest from $3,327 a month down to $2,998.
So how much savings?
$329 per month.
Dang. Yeah, that's crazy. $329 a month for free.
Yeah, exactly.
Because the way we structure it is you're refinancing without paying origination fees, without paying discount points, without paying any of that. So you might pay a little bit in third-party costs, like a couple thousand in title fees, maybe an appraisal. So we're talking less than $3,000 in fees on a home that size, and you're saving $300 and some odd per month, but you're also skipping 1 or 2 monthly payments immediately, which are probably $3,000 as it is. So by the first skipped payment, you've already recovered all of the expense that you faced, and then you might skip another payment, and then you're going to save $300 and some odd per month every month.
And this is the realized gains in terms of monthly savings. Oftentimes when I'm reviewing, I'll just do a review without doing an actual loan application at first, but then
every time.
Yeah, basically. Exactly. But then once we get an actual loan application in, what I'm seeing right now, a lot of borrowers' credits has increased because if they're first-time home buyers, they added a mortgage debt to their credit, which helped their credit. Now they're in a better tier for rates, but also mortgage insurance can be cheaper. Maybe they've got more equity in the house, so they're saving in other ways too that we don't even realize.
Well, and I've got a client that I just spoke with this morning that we're doing a refi. Pretty similar circumstance. He's got a smaller loan, so the savings aren't quite as significant, and we're actually only cutting his rate down by 3/4 of a point, not even a full point.
Okay.
But it's making sense because the refi, there's no cost. He doesn't have any time to break even. He's profitable. The moment he signs on the dotted line, he's profitable on the refi. And then he just has cheaper payments by about $150 a month every month. But what we're doing is getting super creative and structuring it where he's getting $2,000 cash back, because you can't on a regular refi, you can get $2,000 cash back. He's getting an escrow refund, which right now he's got like $2,500 in escrow, and we're structuring it where he's skipping 2 payments. So $2,000 plus $2,500 is 2 payments are about $5,600. So he's getting like $10,000 net in his pocket,
plus a lower monthly payment.
And that $10,000 he's using to go pay off his 401k loan that's against his 401k. That's going to save him $400 per month. So this refi, even though on the surface it's only saving him $150, he's going to save $550 per month for free.
Stupid. Well, and what you've done that's cool there too.
And maybe that's cautious. I should caveat that. Not for free, but no actual cost.
Yeah. What you've also eliminated too is now he doesn't have to stress, because he doesn't have to worry about his break-even time period. He's already broken even. Now he just needs to continue watching rates and do it again. You know, if this trend continues for the next who knows how long.
Because that's the biggest fear and reluctance with clients we talk to is they're like, well, what if rates keep dropping? I'm going to wait until it's like, why? If you can secure a 0.5 point in savings or something with no cost, who the hell cares? Like, you just refi again in 3 or 4 or 5 months.
Right. Which is why our Client for Life program actually is the best for that.
Yeah.
Because we waive our lender fees. After your first transaction with us, we waive our lender fees. So you really only have your title fees.
Which is obscene. And there are so many lenders competing with us on that, but those lenders are waiving the refinance fees one time. So a lot of our clients, you know, are talking to whoever about a refi, oftentimes the mortgage company that they are,
like the
servicer, or their credit union or something. They'll get into a conversation with them and they're like, oh yeah, we do that too. You know, your first refinance, we waive the fees. So the question, I get this very commonly, almost every conversation I've had in the past 2 weeks is like, is that on the first refinance or is that ongoing? And that's something worth highlighting about our Client for Life program, which is when you get into the realm of being a client of the Lassig team, you don't ever pay lender fees again. No underwriting fees, no processing fees, no origination points or fees, none of that. The only thing you'll pay are third-party costs and if you choose to buy your rate down.
Yeah, which in this market, really not advising.
No, which is a huge, I mean, that's super beneficial.
Oh, dude, it's a no-brainer at that point, because it takes out the risk of waiting and trying to time the market. It's like, no, if it makes sense and the break-even is at month 1, do it.
Yeah, 100%. And we were talking about buyers. So the other thing about buyers, which we've talked about on some social media stuff, like some reels we've done and things, one, you should be afraid if rates come down, because you're going to have so much competition that your opportunity will quickly close to negotiate like you can negotiate now. You know, maybe a little plug on that. I had another client looking at a refi. This is one that I told not to do the refi. And that's because she bought about a year ago when the negotiations were about as good as they are now. They might even be a little better now, but she was able to negotiate significant seller concessions. We were able to buy her rate down permanently, and in addition to buying the rate down permanently, get a 3-2-1 buy down on top of that.
Oh, wow.
So she's looking at a refi. She is only at like a 4%, or she's at under 5, I can't remember exactly, under 5%, and she's her second year into this loan. So she's paying a rate that's less than 5% right now, which is insane. And that opportunity exists for people that that take the leap and buy now. But then let's say rates dramatically drop and she can refi to something sub 5% and get rid of that temp buy down. Well, now she just gets a refund of thousands of dollars on her loan for the residual benefit. So
honestly, with that scenario, if she refinances soon, you know, if rates come down, she'll more than cover her closing costs with what's remaining in that temp buy down. And then she could even buy the rate down permanently with what's left over.
Yeah.
That's
which
gnarly.
is crazy. So that, I think, is the opportunity. You have negotiation, and that negotiation won't last. But what we've talked about that I didn't mention yet is the increase in buying power. Like, it's ridiculous. Did you have that? As a bullet point?
It's one of the bullet points. So let's see. So for affordability, that same $330 a month in savings now creates $55K more in buying power.
Does your home and auto insurance seem to go up every year without fail? Mine did too. I thought this was just the way the insurance industry worked until I found my friend Alan Johnson with American Family Insurance. After more than 15 years with the same insurance agent, he saved me over $3,000 per year when I switched. I refer all my family, friends, and clients to him, and their experience is similar. Great rates and a great experience. Call Alan for a free quote today at 801-708-2962.
So now instead of a loan amount of $500K, you could have a loan amount of $550,000 house. $50,000 is, you're looking at different types of homes.
Oh, for sure, especially in that range. Like you spend $1 million or $1,050,000, not a big difference. You spend $450 or $500 or $500 or $550, huge difference.
It could be the difference between a townhome or single family, if that's important to you. Like there's, the sky's the limit.
And not to mention, we've talked about this too, but with the negotiation power, we generally recommend temporary rate buydowns. But for those people that are like, man, I just can't afford a home to fit my family, for example, because rates are so high. Well, go lever really hard against the seller. Rates have come down already. Get 3 or 6% in concessions and dump all that money towards a permanent buydown. And now we just amplify that affordability. I mean, we're talking you can get $100,000 to $150,000 more house in this market, not waiting for anything.
Yeah, and those are my favorite calls to make. It's like to the people that are out shopping, it's like, hey, guess what? Rates have come down. Now instead of your max amount at 500, now you're at 550. Like that's golden, because odds are they're like, oh, sweet. We have a few homes that were out of our price range. We were waiting for them to reduce the price. Now we can go attack them. And
then what I think about is you buy that 550 house, and maybe you ran these numbers, but I'll nerd out and run them myself here.
Okay. While you're doing that, we'll hold on that. For the people that were comfortable making their monthly payment and they refinance, they're saving at $330 a month. I did the math here. If you were comfortable with making that payment and just reinvested into the market at an 8% return, in 30 years, you've got $450K at your disposal. Because assuming we're starting over with a new 30-year loan. Well, in 30 years, assuming you don't refinance again, which I think is pretty high likelihood you would, but you've got a free and clear house plus $450K in your pocket.
Just by investing that extra $330 a month.
Yeah.
Dang.
Yeah.
So you're making the same cost out of pocket, and in 30 years, you just became $500,000 richer than you would have been without it.
Exactly. Yeah.
Which is nuts.
Yeah,
it's like, that's crazy. Yeah. So the numbers I ran, similar. This is what TJ and I get so oddly nerdy about, which is how do you make money on the money? So that if, say you bought the house that was $50,000 more expensive, which is what it enabled you to do, or reinvest somewhere else, those savings, that you have in only 10 years, you have about $35,000 in additional equity in that home just because you bought the 550 house and you're paying the same payment. So in 10 years, you made $35,000 for
which
nothing.
Is a no-brainer. I mean, that's how you maximize your wealth. And that's what we talk about with real estate too. Buy the most expensive home you can as long as you're comfortable with monthly payment. Like find your max comfortable monthly payment that you're comfortable with, and then reverse engineer to get the nicest house. Yeah.
Because the nice thing is, what I commonly think about, that absolutely makes sense. We don't want you to be house poor, but whatever you believe you can afford, max that out, because then you put your budget in a place where you're investing what you know you can afford into maximum real estate to maximize wealth long term. And instead of your budget being free and you spending that money on a coffee or a soda or some other stupid thing and wasting it, you're making thousands and thousands of dollars and you live in a nicer home. You're happier.
And you're creating opportunity for leverage later on. Like there's just, the sky's the limit when it comes to the opportunity.
Socioeconomics, you're around neighbors that are probably more affluent and giving you better opportunities because you live in a more affluent neighborhood. Like there's countless benefits to that type of thing.
For sure. For sure. I really think this is the beginning. I don't think it's going to, there's going to be some bumps in the road with political state we're seeing with, I mean, you know, our affairs overseas. It's going to happen. It's bound to happen. But what I can say is take the opportunities we have in front of us and take what you have, because we don't know when and if rates are going to go up, down, what it really holds. Now, a lot of economists think that this trend is going to continue, but we've heard that in the past.
Definitely. Well, and to speak to that, we've also seen projections or forecasts be wrong time and time and time and time again. We've seen, home prices are going to tank. Well, they haven't. They've actually gone up about 5% or more. And that's even accounting for some pretty bad drawdowns over a few months where month over month prices went down and then they recovered and came back up, and we're still seeing average or above average returns on real estate. I was doing some research today on some other investing, and it was just related to the S&P 500.
Mm-hmm.
And I was like, what does the forecast look like over the next decade? Because we've had a really strong decade in the S&P 500. Like the last 10 years, the S&P 500 has turned a profit of over 15%.
Wow, which is well above the lifetime average.
By way above. But then there was a period, it's called the lost decade, from 2000 to 2010, where it was virtually zero.
Interesting.
Yeah, and in the middle, so then I was just kind of running different scenarios because I feel like we're
just out of curiosity, and sorry to cut you off, was there a run up to 2005 and then
up to 2000?
I thought you said it was from 2000 to 2010.
Yeah.
Was there a run from 2000 to 2005 or like 2008, and then the crash of real estate caused that to level it out?
No, you had the dot-com bubble in like 2000, and then you had the real estate crash and the Great Recession in 2008. That's why they call that the lost decade, because they were too extreme.
There were probably some gains in between, but then that leveled it off.
Right, but then what I looked at is I'm like, okay, well, doesn't that leave a huge opportunity for dollar cost averaging into that market long term, because you're buying at depressed levels?
Right.
So if you kept dollar cost averaging, that is, if you dollar cost averaged into the market during that period for, I think I ran it 20 years, you averaged 12%. Still above the average, but that's because you're buying at a discount, and then you rode the wave up. But what I was getting at with this was the forecasts 10 years ago for the decade that we just experienced. So before we experienced the decade, the forecasts ahead of that were about 6%.
Oh, wow.
We saw 15%. Guess what the forecasts are for the next decade?
I mean, it can't be as good as what we've seen.
6%. So forecasters don't know what the hell they're doing. Yeah. They're putting a conservative number, and maybe they'll be right, maybe they won't be. But what I see is if you are consistent and prudent and unemotional with your investment decisions, you're going to make boatloads of freaking money. Just do the thing. Stop trying to time it and question, is now the right time? Should I do it? I shouldn't do it. So-and-so said that the home prices are going to crash, or this is going to happen. It doesn't matter. But this is a long-term investment. Buy it. Sit on it for 5, 10, 15, 20 years, and you will be so thankful. Your future self will be so thankful that you made that decision in virtually any environment. You can't paint a period of time. And the beauty with real estate is virtually any investment, as long as you're unemotional, you don't ever have to sell.
Yeah, it's true.
You only lose money when you sell.
It's time in the market, not timing the market.
Right. And it's like, if you want to liquidate and it's not a good time to liquidate, well, hang on to it and rent it out. You're probably going to profit while you rent it out. And then if you really want to liquidate, sell when the upswing happens again, because they happen. Which
I think brings us to a good point. You've got some first-time homebuyers that have bought in the past year and a half, maybe even 2 years, that they can't refinance. They technically might be underwater in a little micro market. Hang on tight. That's all I can say, because as we start to see an uplift with rates coming down, if we start to see an uplift in buyer activity, now you're going to have the equity you need to refinance. I'm not saying it's going to be instantly, but there's going to be an opportunity with the next couple of years.
And a plug on that, which is something that I'm advising some of my clients lately, is why don't we look at an FHA loan? Right now, even though you qualify for conventional. Well, I ran a loan for a client. The FHA option was 1 full point lower than the conventional option. Now, they have upfront mortgage insurance on FHA that they don't have on conventional.
But if the rate's that much better,
a full point,
we'll help you run the break even on that. Odds are it's going to make sense, especially if it.
But here's the trick. I can streamline refinance an FHA loan. I can't do that on a conventional, so I don't care what the hell values do. If rates come down, I do no appraisal, no credit qualifying, streamline refi. I get the lower rate whether I'm underwater or not. It doesn't matter. So there's a little hidden benefit.
A little bit easier process too.
Way easier process. Basically, don't do anything. You just say yes.
I'll accept the savings.
Right. Yeah.
Oh man. So I think, if this is something you're considering, whether you're in the market looking to buy or you need to refinance, you bought within the past year, couple of years, give us a shout. We're here for you, and we'd love to help out.
Yeah, for sure. I think we offer free advice all the time. We get paid when loans close, but all the advice that happens, which is 95% of our jobs, our team does a bunch of the other stuff, but 95% of our jobs is essentially just giving free advice and guidance based on experience of thousands of transactions and studying the market for hundreds and hundreds of hours that we've invested. So lean on us. We would love to help. And if you found this valuable, or if you didn't, like, subscribe, share, comment, do all the things, please. It does help us. And frankly, we kind of get excited when we see like a share or a comment. It's like an evidence of success for us. So we
get more excited when we get subscribers, likes, and comments. We do like our paychecks. So,
so please help us out. Just feed our souls, please. Anyway, thanks for tuning in.
Thanks, guys.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.